Good morning. I am Devika, Assistant Professor of Commerce, A.D.M.COLLEGE firm in Nagapattinam. Now let us see ratio analysis. The meaning of ratio analysis. Ratios are the relationship between two figures expressed mathematically, and it is a numerical relationship between two numbers which are related in some manner. Ratio analysis is a technique of analysis and interpretation of financial statements. It is the process of determination and interpretation of various ratios for helping in decision making. Ratio analysis involves normally 3 steps. Number 1, calculation of appropriate ratios from the financial statements. Number 2, comparison of the ratios with the standards or with the ratios of the past period. Then it is the comparison which can also be made with the ratios of other firms to find out the favorable and unfavorable conditions. By comparing this, the third step is interpretation of ratios with the different statements. Next one is uses. The uses of ratio analysis is not confined to financial managers only, because it is the different parties which are interested in knowing the financial position of the firm for different purposes. Next one, ratio analysis is used by the creditors, banks, financial institutions, investors and the shareholders. It also helps them in making the decisions regarding granting of credit and making investment in the firm. That investment may be either long-term investment or short-term investment related to the firm. Next and the last one is ratio analysis is of immense use and has wider applications. Next one, the uses is given under different heads wise. The managerial uses of ratio analysis simplifies the financial statements, which helps to have a comprehension of financial statements, which also explains the whole story of changes in the financial condition of the firm. Number 2, it helps in measuring the performance and position. Through the leverage and the solvency ratios, the ratio analysis helps in assessing the financial position of the firm. Similarly, the activity ratios and profitability ratios are also useful in evaluating the performance of the firm. That means it helps to have that means knowing the financial condition related with the favorable and unfavorable conditions of the firm. Number 3, facilitates intra-firm comparison. Comparison of ratios of the same over a period of years can also be made. That means this will help to know whether the financial performance is improving or reducing, it is deteriorating. Similarly, a comparison of the performance of different divisions of the firm can be made to assess their relative efficiency with the other co-workers who are working in different departments. Fourth one is facilitates inter-firm comparison, which has absolute figures are not suitable for comparing between two or more firms. Ratios of a firm can be compared with the ratios of similar firms in the industry. Such a comparison will indicate how well the company is operating relatively to its competitors, how well they are competing with the competitors. Fifth one, helps in forecasting and planning. How it is supposed to forecast their future, how they are supposed to plan in advance about their future. So here the profitability ratios indicate the trends in cost, sales, profit, etc. The ascertainment of trends helps in making forecasts. Next one is helps in coordination, which helps to coordinate the activities of different departments of the organization. So here ratio analysis communicates the financial strength or weaknesses of the firm in a more easy and understandable manner. Such a clear communication helps in better coordination of the enterprise of the workers who are working in different departments. Next one is helps in control. Comparison of actual ratios with the standards reveals the deviations and weaknesses. That means it helps the management to take corrective action at the right time, to take up the right step to compete with the competitors or to achieve the target or the goals of the concern. Control of cost as well as performance is also ensured by comparing or fixing a standard with reference to controlling of the workers of different departments. Next one, classification according to statements. The ratios are classified into different segments. Number one is according to the statement how we are supposed to classify the ratio analysis. Number one is profit and loss account ratios. Here ratios are calculated on the basis of items of profit and loss account only. That means selling expenses ratio, administrative expenses ratio, then overhead expenses ratio. Just like that, we used to segregate the ratios according to the information or the details given in the profit and loss account. Next one is balance sheet ratios. Here in case of balance sheet ratios, they are supposed to calculate on the basis of the figures of the balance sheet only. That means balance sheet, we used to have assets and liabilities. In that circumstance, we used to consider the current ratio, liquid ratio, acid test ratio. Just like that, we used to compare the assets and the liability position. With reference to that, we used to find out the capital gearing ratio. Based on that, the information given under balance sheets are calculated, means then that comes under the classification according to balance sheet ratios. Last one is composite ratio. It is nothing but based on the figures related to profit and loss account as well as balance sheet. That means it is a combination of the ratios which have been calculated under the two statements. That means P&L account as well as balance sheet ratio is called as the composite ratio or a combined ratio related with P&L account and balance sheet. Next one is classification according to function. So this is normally followed by the organizations where they are supposed to follow such ratios to find out the financial condition of the organization related to different departments. In that, number one is solvency ratios. So in case of solvency ratio, they find out the solvency position of the organization, whether they are solvent or insolvent. To find out the favorable and unfavorable condition, they are finding out the solvency ratios. So in this solvency ratio has been categorized into two, namely short-term solvency ratios and long-term solvency ratios. Here in case of short-term solvency ratios, we are supposed to calculate current ratio, liquid ratio, quick ratio, etc. Just like that, in case of long-term solvency ratios, we are having different sorts of ratios which covers a period from 2 to 5 years or for a longer period is called as a long-term solvency ratios. Next one is profitability ratios, where we are supposed to different sorts of profitability ratios wise GP ratio, that means gross profit ratio, net profit ratio, operating profit ratio, etc. Next one is turnover or activity ratios. In case of turnover, we are supposed to calculate what is the sales related with the organization. So the sales is referred to as the turnover. So what is the trend related with the organization related to sales or the achievement of target, which will be the main target or the goal of the organization. They are supposed to consider this turnover or activity ratios. Next one is capital structure ratios. So this may be considered as the capital gearing ratio, where they are supposed to find out the profit plus the fixed interest bearing securities, how they are supposed to get the returns with reference to the capital, how they are investing, for that how much they are getting returns is considered to be the capital structure ratios. Now the next one is, we used to see the liquidity ratios in detail. Now this liquidity ratios is otherwise called as short-term solvency ratios. Liquidity ratios measure the ability of the firm to meet its current obligations. They indicate whether the firm has sufficient liquid resources to meet its short-term liabilities. Short-term liabilities in the sense which is meant for 1 year. So the following are important liquidity ratios. Here the current ratio is the first one related to liquidity ratios. Current ratio means here they used to refer the current assets and the current liability. So current ratio is the relationship between current asset and current liability. It is the difference between current asset and current liability. So current asset refers to stock, debtors, cash, prepaid expenses, etc. Just like that, current liabilities refers to bills payable, sundry creditors, outstanding expenses. Just like that, we used to include the short-term liabilities, and we used to find out the difference between the current asset and the current liability. So the relationship between these two, current asset and current liability, is referred to as current ratio. Here the current ratio is of 2:1, means it is considered as ideal. Otherwise they have to take up further step to improve their ratio condition to the setting standard norm, which is considered to be 2:1. Next one is quick ratio. Quick ratio is otherwise termed as liquid ratio or acid test ratio, because it is acid test of a concern's financial soundness. It is the relationship between quick assets and quick liabilities. Quick assets are those assets which are readily converted into cash. That means if we are supposed to have quick assets, means we used to take up the current asset, and if we reduce the stock and prepaid expenses, we used to get the quick asset. Then what are quick liabilities? The same, we used to take up the current liabilities. If we used to reduce bank overdraft, that will be quick liabilities. So in that circumstance, the quick ratio is 1:1 means considered satisfactory. If the quick ratio supplements the current ratio, we used to have, if there is any difference, we have to take up the further step to make a remedial measure to balance that particular quick ratio. The formula to find out this quick ratio is quick assets divided by quick liabilities. Next one is solvency ratios. This solvency ratios is otherwise termed as long-term solvency ratios. The other name for solvency ratios is long-term solvency ratios. The solvency ratios assess the long-term financial conditions of the firm. Bankers and creditors are most interested in liquidity, but shareholders, debenture holders and financial institutions are concerned with the long-term financial prospects. In this long-term solvency ratios, we used to have the first ratio as debt equity ratio. So we used to find out the relationship between the debt and equity. The debt equity ratio establishes the relationship between the shareholders funds and the outsiders funds. So outsiders funds include all long-term and short-term debts, and the shareholders funds consist of preference share capital, equity share capital and reserves and surplus. So here the standard debt equity ratio must be 2:1, which is considered as ideal. So the formula to find out debt equity ratio is debt divided by equity, or debt, that means long-term debt divided by shareholders funds. So here long-term debt refers to the fund which is related with the organization for a longer period of years, say more than 1 year. Next one is proprietary ratio. Proprietary ratio is the relationship between proprietors funds and total tangible assets. So here total tangible assets includes, other than goodwill, other than intangible assets, we have to include all sorts of tangible assets. Tangible assets means either it may be related with furniture, plant and machinery, etc. We used to take up all sorts of tangible assets in excluding intangible assets. Now proprietary ratio indicates the proportion of shareholders funds in the total assets. A high proprietary ratio indicates less danger and the risk to creditors in the event of winding up of the company. Now proprietary ratio is equal to shareholders funds divided by total tangible assets. That means we have to take up only the tangible assets excluding intangible asset. So intangible assets means we used to know it is goodwill, patent, trademarks, etc. Now the next one is profitability ratios. Profitability ratios measure the profitability of a firm's business operations. These ratios may be related to sales, that means we used to take up gross profit ratio, or investments, which is considered to be return on assets of capital employed. So capital employed, return on capital employed means it is nothing but profit. So here this profitability ratio is categorized into different ways. Number one is GP ratio, that is gross profit ratio. Here this ratio expresses the relationship between gross profit and net sales. That means it indicates the efficiency of the overall operations of the firm. That means it shows that percentage of sales is left to the owners after meeting all costs. That means it cost refers to total variable cost, fixed cost, semi-variable cost, all sorts of costs. So here an increase in net profit ratio is an indicator of improving the working conditions and vice versa. Vice versa means decrease in net profit of the year is an indication of reducing the working conditions. So just like that, we have to make the conditions either related with the favorable or unfavorable condition by means of considering the GP ratio. Now to calculate the GP ratio, the formula is GP ratio is equal to gross profit divided by net sales into 100. Next one, net profit ratio. Here net profit ratio is the ratio which expresses the relationship between net profit and net sales. Here it shows the net revenue of the owners of the firm. That means net profit means by taking the gross profit, we have to take up the expenditure related with the factory and the incomes related with the factory. We have to make adjustments. That means the office expenses and office revenues, and we have to find out the net profit. Then we have to calculate the net profit ratio. So with the revenue and the cost, we have to max, that means categorize, we have to reduce, make adjustment, and we have to find out the net profit. Now, to calculate the net profit, the ratio is equal to the formula is net profit divided by sales into 100. Next one, operating ratio. Here in case of operating ratio, which matches the cost of goods sold and the other operating expenses with sales. That means operating ratio shows the percentage of sales absorbed by the cost of goods sold and the operating expenses. Here, lower the ratio is more favorable as it would leave a higher margin for operating profit. So, we should not consider here the non-operating items. We should not take up non-operating expense. So, non-operating expense means here depreciation, preliminary expenses, written off, those expenses are considered to be non-operating. That will not be considered in case of operating. So, to find out operating ratio, the formula is cost of goods sold plus operating expenses divided by sales into 100. Next one is return on capital employed. Here in case of capital employed, how much they are employing capital in the firm. Return on capital employed establishes the relationship between profits and the capital employed. It is most widely used to measure the overall profitability and the efficiency of the business. So here return on capital employed in the sense automatically what the amount invested, for that what is the return they are getting. That is, the return means it is the profit. So return on capital employed is equal to net profit plus interest plus taxes divided by average capital employed into 100. So to find out the average capital employed, we have to apply the formula. That means opening capital employed and closing capital employed will be given. So opening capital employed plus closing capital employed divided by 2 means we used to get average capital employed. So after getting this average capital employed, we have to apply in this formula net profit plus interest plus taxes divided by average capital employed into 100. Or we have to find out the capital employed is equal to total fixed asset plus current assets minus current liability. We used to get the capital employed. Or the other term, shareholders funds plus long term liability. Either we have to take up the asset side or the liability side. If you used to take up the asset side, fixed assets plus current asset minus liability. If you used to take up the liability, shareholders funds minus long term liabilities, we used to get capital employed. Next one, activity or turnover ratio. In case of activity ratios, we used to measure the efficiency of the asset management. We used to have different types of assets. Fixed asset, current asset, intangible asset, tangible asset, fictitious asset, etc. So in that circumstance, to manage the assets, we are supposed to have this activity ratios or turnover ratios. The efficiency in the use of assets would be reflected by the speed with which they are converted into sales. So here this asset utilization is referred. So in that circumstance, activity ratio indicates the relationship between sales and the various assets of the firm. As I said, the asset refers to, various assets refers to fixed asset, current asset, intangible asset, tangible asset, etc. or fictitious asset, etc. So all these are considered to find out the turnover ratio. Next one is stock or inventory turnover ratio. This ratio indicates the number of times stock is turned over during a year. So in this case, a high ratio indicates quick movement of stock and vice versa. That means high ratio indicates quick movement of stock and low ratio indicates the fast movement of stock. Just like that we have to refer. So stock turnover ratio is equal to, we have to apply the formula cost of sales divided by average stock. Next one is debtors turnover ratio. In case of debtors turnover ratio, normally we used to find out to measure the credit sales related to debtors. So in this case, this ratio shows that on an average, the number of times debtors are turned over during a year. So a higher ratio indicates the efficiency in asset management and lower the ratio indicates the lower efficiency in asset management. So average collection period. So to find out debtors turnover ratio, the formula is credit sales divided by debtors. Next one is average collection period. This ratio shows on an average the number of times debtors are turned over during a year.
So here also a higher ratio indicates the efficiency in asset management and vice versa. So to find out the average collection period, the formula is debtors plus bills receivable divided by credit sales into number of working days in a year. So we have to take up total days in a year as 365 or 366 according to the leap year or not a leap year. We have to calculate this average collection period by means of considering the number of working days in a year. Next one, creditors turnover ratio. This ratio on an average, the number of times creditors are turned over during a year. Higher the ratio indicates quick settlement of dues and lower the ratio reflects liberal credit terms granted by the suppliers. So how we are considering the sales, credit sales in case of debtors turnover. In case of creditors turnover, we are considering the credit purchases. So in that circumstance here, we are supposed to calculate the term, that is creditors turnover ratio, by means of applying the formula that credit sales divided by creditors, credit purchases divided by total creditors. So here average payment period we have to consider in case of creditors turnover ratio. It refers to the number of days taken by a firm to pay its creditors. The firm has purchased from different suppliers. For them, the firm has to pay amount. Those persons are considered to be the creditors. How they are supposed to pay the amount to their creditors, that is called as average payment period. So to calculate the average payment period, the formula is creditors plus bills payable divided by net credit purchases into number of working days in a year. Next one, fixed assets turnover ratio. Fixed assets turnover ratio explains the relationship between sales and fixed assets. That means the formula is sales towards net fixed assets, therefore sales divided by net fixed asset. So net fixed asset is nothing but land and building, plant and machinery, just like that. How it is fitted to the land. We are not supposed to move that asset. It is called as fixed asset is nothing but which is meant for a longer period of year. So in that circumstance, we used to consider those assets as net fixed asset. So this ratio indicates the sales generated by every rupee invested in fixed assets. A higher the ratio is an indicator of greater efficiency in the utilization of fixed assets. Next one is, last one, capital gearing ratio. So in this case, the ratio explains the relationship between equity shareholders funds on the one hand and preference share capital and fixed interest bearing loans or securities on the other hand. Here, in case of this equity capital or preference capital, they used to have the segregation of capitals. Equity means the items or the capital which is not of a preference capital is equity capital, and preference capital or those capital where they are supposed to get a preferential right with reference to payment of dividend. So that is called as a preferential capital. So in this case of capital gearing ratio, to find out the ratio, the formula is preference share capital plus fixed interest bearing securities divided by equity shareholders funds. How much they are having in equity shareholders funds, that must be divided. So here if the preference share capital and fixed interest bearing securities exceed equity shareholders funds on the other hand, and preference share capital and other fixed interest bearing securities are less than the equity shareholders funds. Hence they used to consider both the capital, both preference and equity plus the fixed interest bearing securities, that means the debenture holders interest, etc. Next one, limitations. Limitations with reference to the ratio analysis. Number one is inadequacy of standards. Normally ratios, we used to fix up certain standards and we used to consider the conditions related to favorable or unfavorable conditions. So in that circumstance, here this ratio analysis is of having inadequacy of standard. Ratios are useful only if they are compared with some standards, but adequate standards like industry averages are not easily available. Number two, limitations of financial statements. Ratios are based only on the information recorded in the financial statements. Financial statements suffer from a number of limitations. Third one, ratios alone are not adequate. That means ratios are only the indicators. They cannot be taken as a final regarding good or bad financial position of the firm. Other things have also to be seen to fix a condition related to the firm, whether it is favorable or unfavorable. Next one, difficulty in comparison. In actual practice, it is difficult to have similar companies for comparison. Next one, problem of price level changes. Ratio analysis does not take into account the effect of changes in price level. Because of this, interpretation of ratios become invalid. Next one, window dressing. Financial statement can easily be window dressed to present a better picture of the financial and profitability position. That means while they used to get a loan from a bank or financial institution, they used to make certain alterations to get the loan facility from institutions. So in that circumstance, the statements have been window dressed to present a better picture to get the certain financial resources from the institutions. Hence, it is considered to be one of the limitation. Next one is personal bias. Here, ratios are only a means of financial analysis. They have to be interpreted, and it has been two different people may interpret the same ratios in different ways. Hence, the assumptions of one person vary from one person to another. This is considered to be the limitation with reference to personal bias. Next one is no fixed standards. Here, no fixed standards can be laid down to fix the efficiency related to the organization. Hence, it is considered to be one of the limitation. Last one is no indicators of future. That means ratios are generally calculated from financial statements. Hence, they are the indicators, no indicators of the future. It is only a prediction. They are not supposed to consider the predictability with reference to the organization. Why? Because the future may be uncertain. So, in that circumstance, it is considered to be one of the limitations of the ratio analysis. Thank you.